This is Lex. This is Lex Luthor. And for the past 39 years, Lex has been involved in the stock and options trading business. He began his career as a market maker on the Chicago Board of Options Exchange in 1987. After years as an independent market maker, he and his three partners created a options trading company. He became CEO and managing partner of the company and oversaw its growth into one of the largest designated primary market making firms in the U.S. After his prop trading firm and clearing arm were sold in 2005, Lex continued as a professional trader until 2017. In 2017, Lex and his business partner created a retail trading platform called TradeHawk and connected their platform to the Tradier brokerage. TradeHawk enjoyed success as a private technology company, and in 2020, Tradier purchased TradeHawk. Today, Lex is the SVP of Business Development and Partner Relations, as well as the Chief Content Officer for the Tradier Hub, Tradier's educational ecosystem. He also oversees the continued development and enhancements of the Tradier Pro platform, formerly TradeHawk. How about that? He hosts regular Hub and YouTube broadcasts on stock and options trading called the Traders Workshop and the Market Wind Down. These shows spotlight educators, mentors, and industry leaders in an effort to offer exciting educational content to the Tradier community. Lex, that's quite the mouthful. I'm glad you're here, my friend.
You told me you wanted a bio, man. That's like a book. Holy cow.
Dude, not just a book, but we got like multiple chapters inside of this book.
Awesome. So what's this all about? What are we doing?
So we are in the middle of class. This is Outlier University. This is our way to help all of our traders with absolutely no cost whatsoever, help them save time, make money, and start winning with less risk. I've been teaching them literally everything I know from 17 years of trading. And we have some incredible success stories. Lex, one of our students who was in the alpha class has tripled his account in 2026. Like that's the kind of successes we're having right now. That's absolutely nuts. Gangbusters results. So, but I want to hear from you. In fact, all of our students are here excited to learn from you. And if you need to screen share, just let me know. I'll hand it over to you. And I'm really curious to see some of the things that you could teach us. In fact, Lex surprised me one day. We were having a conversation and he's like, "Hey, Chris, did you know a really easy way to look at the extrinsic value is just to go look at the price of the put?" And I was like, "What? I've never heard of this. What are you talking about?" And so at that moment, I was like, wait a minute, Lex is way smarter than me, obviously. So I want to learn as much as I can from you, Lex. We can go in any direction you want to. And of course, our students are going to ask questions. I'm going to ask questions. So this is a Lex show.
Yeah, oh, man, I wasn't prepared for the Lex show, but my goodness, nice to see everyone. Appreciate it. So, yeah, just so we're clear, right? When I say I was a professional trader, all that means is that I was registered with the government. Okay, so I had to be a broker dealer. I had to take a test, blah, blah, blah. And I had to provide two-sided markets. So all the markets that you trade on in the options world, there's somebody or something that's making those markets, right? They provide risk capital and they provide a bid and an ask for every option that you see on that screen. Now, it's not the same person or the same entity. When I started, 40 years ago or 39 years ago now, it was a human event, meaning I put on my sneakers, I put on a funny tie, I had to wear a trading jacket, and I'm not in my studio. I apologize. I was rushing around, but my original trading jacket's in my studio. That was required, okay? And we actually went down to a trading pit like you've probably seen in some old movies. And we stood there and we beat each other up. We poked each other in the eye with pencils. We spit on each other. We yelled and screamed and we had fun, but we were also very competitive. That entity, that whole process was what you're seeing now on a screen. We did that manually back 40 years ago. Okay. No computers whatsoever. I had a piece of paper, a pencil, and two clerks standing behind me. And when we got busy, you had to write the cards, the trades up physically, and I tossed the cards over my head, and I would hope they catch them. And you guys know what deltas are, right? Everyone knows what a delta is. Well, that was very important to us market makers. What our delta was at all times, we always tried to be delta neutral. Okay, so we had no idea about direction. If you said, "Lex, look at a chart," I'd say, "I don't know what a chart is. Turn it upside down." It means the same to me as right side up. I have no idea how to read one. Okay, Chris is teaching me that. So we didn't care because our edge proposition was buying the bid and selling the offer. and doing it millions and millions and millions of times every week, month, year, throughout. And as a result of that, we would be given inventory, option inventory, stuff that you guys wouldn't want to have, but we're willing to take the risk on, right? So you're saying, well, why would you want to do that? Well, I get to buy the bid and sell the offer all the time. That's my edge. And my theoretical value is somewhere in between those two markets. So for me, I had to manage that Greek profile all the way down to rho. So delta, gamma, theta, vega, rho, I had to pay attention to. And then there's sub-Greeks called Vana and Charm that no one had a name for back when I was doing this. We just kind of intuitively knew what that meant. We didn't have a name for it. So second order Greeks that we had to pay attention to as well. And the way we used to deal with some of that is on Friday, after having a few beers late in the day, going back to the floor, we'd move our data ahead to Monday, see what our deltas were over the weekend. Well, that's delta decay, charm, right? That's charm doing its magic on you. So we had to do those kinds of things just intuitively, right, to figure out what that was. But we were masters of risk analysis on the fly, right? And interesting, Chris and I had a conversation. He's a big premium buyer. And I struggled being a premium buyer when I first got into the markets. I lost all my backers' money in 6 months, okay, when I first started. So it was quite a feat, don't get me wrong, because it dripped out like a little water torture along the way. In 6 months, it was all gone. I'm like, geez, that was fast. And then I just started, he re-upped me, put some more money in my account. And I started kind of talking to the guys in the pit once I became friendly with them. They weren't friendly with me at first. They wanted to kill me. But I persevered, and I started learning a few things about selling premium safely. I didn't do it safely at first, and that's another horror story. But I ultimately learned how to do it pretty well. So interestingly, a retail person probably does better on the buy side of options, quite frankly, than a pro trader. I still have that old sell premium mentality, so I still do that a good bit, only because I am absolutely a D- student in direction. I have no idea. That's why. So having said that, I try to take advantage of implied volatility relationships so that I sell things that are expensive and I buy things that are cheap, just like you would do in your businesses if you have them, or with your car, your T-shirts that you want to sell. You want to get a good price for them, right? There's a value and a price. I want to sell things higher than the value, and I want to buy things lower than the value all the time, right, if I can. So I became a pretty good student of implied volatility. I still am. And, I've been doing it so long, I can look at virtually any spread that you give me. Typically, if I, especially if I know the stock, I can tell you whether it's high or low, whether you should be buying it or selling it. But that just comes from experience and just knowing implied volatility in my stocks, right? I know I spoke a lot. Sorry. That's just kind of a little bit of an intro. But if you have questions, I'm happy to answer them. Or Christy, where do you want me to take the next?
Dude, I've got a handful of questions already. So one question that has come up several times for outliers is, for me, when I'm looking to buy an option, I want to see at least 250 on the open interest. Now, what I ever heard was you need at least 4 to 6x the number of contracts you're going to buy. Now, when I was just trading on my own, 250 is fine. But now a lot of people are listening to what Chris is saying, at your own risk, by the way, just a random guy on the internet. And we're probably taking up 10,000 contracts at a time. If a open interest shows 250, maybe 300, right? Very low in the grand scheme of how many being bought at one time. Yep. How does that translate to what the liquidity actually looks like, right? Because obviously we're getting filled a lot more than just the 250.
Yeah, so I think what happens there is from the market making community, open interest and volume are pretty good barometers to see whether you should be a participant in that particular underlying. You could probably I did a show on this today, as a matter of fact, on our live traders workshop. One of the guys in the show said that there's probably 250 products that are listed, optionable products that are listed, that are top tier products that have great liquidity. Market making community can gobble up just about any size that's out there. And beyond that 250, 251 and beyond, all of a sudden it precipitously drops off pretty hard. So my answer to the question is, depending on the price you're willing to post, a market maker will take the other side of anything. irrespective of liquidity. Okay. They will be able to take the other side of anything. So if you are going to trade in a stock that has 250 open interest in a particular line, okay, a strike, and you have 10,000 to go, they are going to give you a price. You might not like it though. Okay. You will get a fill, but it might not be pleasant. And that's just the way it is. So what happens to that market making community, remember what I said earlier, they are little cuts and nicks every day with the market maker. That entity, and I would call it a person or a him or a her, but it's not that anymore. It's a computer, right? These are large billion-dollar firms now. They want that activity back and forth, just like a bookie does. And I don't mean to make it sound like it's gambling, but a bookie wants both sides of the market. They want to see who's buying, who's selling, so that they can take the middle piece. That's what a market maker does. So if you get too one-sided in a really thin instrument, they are going to make you pay for it. They're going to give you a fill, but you are going to pay dearly for it. Okay, to the point where you may not be able to get out of it because you've paid so high or sold so low, and they're going to hedge that risk up pretty handily. And don't forget, the market making community now, they have the whole globe to fees their risk now. Everything is dispersed in a market maker book. In the old days, it wasn't really like that. You had individual entities who just had to self-contain in their own space. These massive firms, there's only 7 or 8 of them left. Okay, they use the globe to defease risk. Does that make sense?
It does make sense. So
can everyone talk or no? Are they allowed to talk?
Oh yeah, for sure.
Oh, okay.
Yeah, I have several questions on my side.
Nodding and shaking heads. I'm like, this guy doesn't make any sense.
Chris beats us severely if we talk out of line.
Okay. Just to make sure. You guys are real, right?
Oh yeah, they're real. I have several follow-up questions though. Okay, so if that's the case, right, is there a minimum open interest that you would be looking to take for yourself if you were a trader on any one particular strike? Like, is 250 minimum, 1,000 minimum? Like, where would Lex go? Where would Lex feel comfortable?
Yeah, I don't have a hard and fast rule, but I do have is what I like to see in any stock when I look at it. I like to see from 25 delta to 25 delta, put to call. I like to see open interest all along the way. Okay, now what open interest? I want to see minimum triple digits, preferably 4 digits, and really happy 5 digits and beyond.
You mean cumulatively all the way, or like on individual strikes?
Every line. Okay. I want to see open interest in every line from 25 delta to 25 delta. That's a long way, right? And I want to see, preferably 4 digits if I can, and 5 digits makes me really happy. I wear different color socks when I get 5 digits. I just change my socks right away. Don't ask me why. It makes me happy. So.
Oh, you're good. I'm taking notes because I have these actual questions.
Because listen, and I'll give you another little tidbit here that I personally made a mistake on recently. I was on a telephone call, and I'm always on telephone calls. Chris, you probably know this, but one in 1 year and the other year on a Zoom call, trying to manage 3 different things, right, and trade at the same time, which is really stupid, by the way. Anyhow, I was rolling something in one of my positions, right, and it was 2-legged thing that I had to move out. So it was 4 legs in the roll, right? Wasn't paying attention because I was doing a million things. And, our system, Tradier Pro, shows midpoint, shows bid, mid, ask. And midpoint's usually pretty good, right? How bad can it be at midpoint? Most people think. Well, Uncle Lex wasn't paying attention, right? So I saw midpoint. I kind of put the market around that thinking, okay, midpoint, I don't care. That sounds good. Got filled immediately.
That's not good.
Not good.
I know.
But I got filled better. I got filled better by a lot.
Oh, really?
Midpoint. I'm like, holy shit, what just happened? I looked at it and I go, oh, I locked in a loss. That's no good. So my point there is that wide markets can be deceiving. And I was in a wide market scenario, and it was something that was illiquid that I had a position on. I had to roll. I made the mistake getting in the first place. It was dumb. I'm being Mr. Cavalier. Did it anyway. Locked in this. It wasn't a lock-in loss, but it was pretty close. I actually ended up making dumb money on it, but it was. I'd never do it again. My point here is that it is nice to have that liquidity so the markets don't become truck size wide and they're pretty tight. in a pretty tight market, that market maker has felt all the cuts, and those markets are pretty solid, right? Spiders, for instance. Holy cow, you can't go wrong in spiders. Buy the offer, sell the bid, who cares? It's a penny wide. As they get wider, you got to be careful. So one of the things that I'm advocating for here, and this would be good for all you folks, is that you have a theoretical basis on everything you do. Okay, now I'm not sure you guys talk about that, but theoretical doesn't mean midpoint. It's something else. And we have the ability in Tradier Pro, we're adding this to the system so that you can have a theoretical curve that is always available to you that will show you theoretical value. And when you're paying too much, it's going to show something red. You're paying too high, it's expensive. When you're selling something too low, it's going to be green. Okay, it's going to show you that. You can make the decision how much of negative edge you want to do and absorb. That's okay. You're a retail person. That's not your edge prop. But don't give away the farm. Does that make sense?
Yeah. Is that the theoretical column that's already there, or something else?
It is, but it's not purified yet. We're going to purify it. We're going to bless this baby and make it good.
Okay.
So
I'm using that already, so I'm just saying.
Yeah, so it all that's doing is returning a midpoint, which isn't always true, especially in wide markets. So what would have happened in my example, if I had that four-legged spread up there, would have given me a theoretical value for that spread. Midpoint was $4. Okay, I said I'll pay $4. Woohoo! Guess where I got filled? $3.30. They're willing to sell. I was willing to pay $4. They sold it to me for $3.30, and that was still too high.
Right.
Theoretical value might have said $3 on my screen, and I would have said, "Oh, why am I putting this out at $4 when I should be paying somewhere around $3?" I would have changed it immediately because it would have been blaring at me.
Yeah.
To say, "Dummy, don't send this out at midpoint. It's wrong." See what I mean?
Oh yeah, that makes a lot of sense. In fact, I'm looking forward to that.
Yeah, that's why you got to be super careful. The first thing I do when I put up a market, especially in a new stock, I do check the open interest. That's one of my columns. I want to see that consistency, right? Second thing I do is I put the spread or the individual option in the ticket. And I want to see the bid, mid, and ask. I want to see how big it is. Right. I've got the 10% rule sort of in my head.
Okay, that was one of my questions I was going to ask.
Bid and ask 10%.
Yeah.
Yeah, obviously on a penny wide market, a penny at 10% becomes something goofy. So I kind of fudge it with an option price, a minimum option price. But I don't want to see anything beyond that. And if I do, I'll make a call, but if it gets really crazy, 20, 30, 40%, forget about it. I'm moving along. There's too much.
Okay, so let's dissect that just a little bit, because that is actually something I wanted to cover with you. So I'm glad you brought it up. So my hard and fast rule had been 50 cents or less.
Yep.
And then there were definitely some opportunities that I missed out on, maybe like in Tesla or something. It's obviously super liquid, but it might be $3, $2.50 wide, something like that between the bid and the ask. So you're saying for you would like to see a 10% bid to ask spread. Is that what you mean?
Yeah.
As a retail trader?
Yeah. Let's say it's a 10% of the midpoint. That's what I use. If the midpoint's 250, 25 cents is the max. I'll play there, and it's pretty wide, right? And I want. Oh yeah. That's just for me to start thinking. If it's less than that, I'm very happy. If it's more than that, I think I stop thinking right away. I move along. And again, we're talking at the money, right? So make sure we understand that, you're going to get naturally deeper in the money. Options are naturally going to be wider, right, on the call and put side. So we're talking about the band around at the money. So let's call it 40 delta, right? 40 delta put, 40 delta call ish, 35 is fine too. So that's where I want to see that kind of, span.
If you found a bid and ask spread that was 10% right at the, and I'm sorry, students, for asking all the questions. I'll let you guys ask as many questions as you want to hear in a minute. If you found one that was at that 10% bid and ask spread at the money, and then you looked at deeper in the money, like 80 delta is usually where I hang out, but it wasn't that 10%, would you still apply the same rules there, or would you then apply that just on the strike that you're looking at?
I would apply it after that analysis. If you're always trading 70, 80 delta options, I would look for 10%, probably not going to get it. But if the rest of the curve is pretty liquid, I'll probably still make the trade. Okay. Yeah.
So this reinforces the theory that we've been running across, which is the market's able to handle any size orders that we're throwing at it, basically, which has actually been really enlightening. There's definitely been plenty of times early on in my career where I got absolutely hosed by throwing market orders at things. Somewhat similar to what you're talking about, right? Where you get filled and it just happens to be an absolute garbage fill and you had no idea.
Yeah. I'm a big I'm hugely anti-market order. Huge. I wish they didn't exist. Sorry. I know a lot of you are probably saying, well, guess what, Lex? I have another job. I'm a dentist and I got to drill on people's mouths and I can't look at the screen. Well, that's okay. I understand that. Put a stop limit on it and lean the hell out of it. You know, what you don't want to have, and I'll tell you a horror story in a second. You don't want to have infinity as a market. Okay. That's no good. Would you rather get filled at infinity or have to deal with, taking max loss on something? I'm assuming no one's selling naked strangles here and can lose infinity.
No.
But there is a situation recently that happened on an automated system. It was over at IBKR and a little bit with us where, I think it was maybe a Trump tweet. Market went nuts.
You know what we call those, Lex?
Yeah,
we call the Trump tweets golden toilet tweets because that's the only time he pulls out his phone is he's sitting on the throne.
I love it. But SPX went $100 wide, the markets. So what does that do? You have an option that's trading normally at $1.50. Okay, and let's call it $1.25 at $1.75, $1.50 right in the middle. I know they're not that wide, but let's pretend it goes 50 cents at $100. Because of the tweet and all the markets moving one. Guess what happened? It triggered a bunch of stops in an automated system. The system sent out to buy, XYZ option. Guess what it paid? $100.
Ooh.
And guess what else happened? Because it is the responsibility of the user to call an obvious error within 30 minutes of it happening. No retail trader knows how to do that or did it. They went beyond the 30-minute window. Guess what SIBO said? Sorry, to the fiends. Well, that was, in one case, that was a $3 million loss for somebody.
Oh, wow.
Okay, so that's why I hate market orders. There's no way, and most of these people are doing things that are defined risk strategies if they're using multiple options, right? It's very infrequent when you see someone, I'm just going to sell calls and puts naked. The brokers just don't even let you do that, really, unless you have tons of money, right? Most people are saying, I'll sell a call spread. I'll sell a put spread. It's called an iron condor if I do it together, or I'll do one or the other. You know what you can lose. You can lose the difference between the strikes, less your credit, right? Why would you put in a market for that? At worst case, put in a reasonable price plus a lien that gets you the max difference or somewhere near there and call it a day. That you know what you can lose, right?
Right.
So that's why I really hate market orders. So if you use them, I would say if you're using them in spiders, okay, great. Probably not going to be a horrible thing, but man, be careful.
Would you say this? Because literally not 20 minutes before you jumped on, I closed the trade using a market order, but on the stock. And then I opened another trade on the market order on the stock. Would you say the same thing on stock or only on options?
I'd say it on both, honestly.
Okay.
I mean, look at, like normally, 97% of the time, you're probably going to be okay, depending on the stock, I should say. If it's GME, you might not be okay. But spiders and the obvious ones, you're probably going to be okay. But it only takes one bit of news, snippet, an earnings report that's released early. Anything could happen. Korea drops a bomb on us. Who knows? And then all of a sudden, the markets go crazy wide and, it gets nasty, especially if you're opening something, for God's sakes, right?
Right.
Yeah, you guys know what deltas are. We said that already, right?
Yes.
What do you think a lot of deltas are? Give me a lot. That's something you're uncomfortable with. 10,000? 1,000?
Oh, I see what you're saying. I don't know. Let's say 10,000. Sure. Okay,
so that's a lot. That's a 100 lot on 100 deltas, right? Something like that. So when I was in the trading business on the floor, we had to make markets. Remember, I was responsible to make markets. It was electronic. It became electronic toward the end of our career down there. Google, which just released yesterday, I believe. We were having earnings that night, and they're usually released after the bell. So I'm on Central Time, so it's after 3 o'clock Central Time. They come out at 3:05 typically. Market's closed, end of story. You can't trade anymore. The stock just trades in the aftermarket, right? Guess what? Google decided to release them at 2:58.
Oh,
2 minutes before. We're electronically connected as a DPM, as a market making entity. I got strung up on 100,000 short deltas in 1 minute.
Whoa.
1 minute. Our firm did. That was me, but yeah, our firm.
Yeah.
Guess where the stock went? Didn't go down.
Oh, no.
Went up, of course. So I'm looking at $1 million loss in a matter of 30 seconds.
Yeah.
Right. Just like that, from something happening that wasn't expected. So anything can happen. You know, they probably have tons of safeguards now, and most people are smart enough not to do that kind of dumb stuff. But man, you just don't want to let yourself blow in the wind relative to a chance, right?
Yeah, that makes sense. Lex, I have one more question, but then our audience has several questions as well. And I want to leave it to the students first to ask their questions. Lex, so I really struggled to be successful selling options, right? Mm-hmm. And so that makes me wonder, based on what you said earlier, right? Would selling options be something that really is reserved for somebody like a market maker who has access to basically infinite number of trades, infinite bid and ask spreads and things like that, versus a retail trader who really is probably taking 10 positions at a time kind of thing?
Mm-hmm. Yeah.
Oh, go ahead.
So I think either side could work for a retail person. The thing I like to stress for the retail community is, I mentioned it to some degree earlier, know your implied volatility, know what's cheap and what's expensive. Okay. Sell expensive things, buy cheap things. Or if, Chris, in your case, if you're buying 70, 80 delta things, you can still get rung up a little bit on high vol. You can pay up for that. So, understand that part of the game. Where I think being a market maker helps the long premium side of things, and we did see a lot of market makers be long premium, is that because of the theta event in most long premium, that it's not 70 delta. We're buying 30 delta, 40 delta, 50 delta kind of things. Those things have a lot of juice in them, right? Yeah. Those things melt like ice cubes over weekends. Right. So the reason we could do that is because we have so much activity day in and day out that we can defease the theta by just trading and gaining P&L day in and day out. You folks as retail do not have that advantage. You cannot buy a bid and you cannot sell an offer. And someone once said to me, well, I had a bid out there and I bought it. I go, when you bought the bid, it was when it became the offer. That's when you bought it. So you missed it. So yeah, you got to be careful there. Now, the other side of the equation, the short side for a retail person, the beauty of it for me, and the reason I like it is because 3 good things can happen for me. I can have a sideways market. I can have a slight down, a slight up. Okay, those are 3 of the 5 moves. The other 2 moves are huge move down and huge move up, violent. Those are not good for premium sellers. But when you combine it with a risk defined spread, and there's a handful of them, right? You don't have to know a ton of them. You can all of a sudden say, here's my exit strategy. I am going to get out when this spread goes 50% against me, whatever the number is. And I'm going to get out when it goes 50% for me. And I'm going to stick by those rules. And if you can automate that, even better. You should be a winner because you're playing probabilities. And one of the things I like to say is I met a guy young guy, 31, 32 years old. He has a net worth of $12 million. Okay. And he did this from the time he was 21. He is an actuarial for an insurance company. He applied his skill to insurance adjusting to the options market. Guess what he concluded? I should be selling premium at all costs, right? That's what he came up with. You know why? Because he, as an actuarial, can see when premiums are too adjusted high and they should be sold. Example, Warren Buffett is a premium. He owns insurance companies. He sells premium, right? Guess what happens to Warren Buffett occasionally? The hurricane hits the shore and he's got to write a check, right? But would Warren Buffett ever sell you insurance if you lived on Hilton Head Island and there's a hurricane a mile off the beach? Would he sell it to you? Yes, he would. Yeah. He would. He'd sell it to you for $300 million or some number, but he's not selling it to you for $10,000. Right. There is a number, he'll sell it. And that's the beauty of options, is that there is a number on that screen that you should be willing to sell something. And there's also a number that you want to walk away from it or maybe even buy it. Does that make sense?
Right. That makes sense. Yeah.
Yep.
Okay, class. I want you guys to start asking your questions. Do me a favor, raise your hand first, and then I'll call names, and then we'll go to our live audience who's also watching as well. Okay, who wants to go first? Charlotte, go ahead.
Hi, Lex.
Hi, Charlotte. Hi, Charlotte.
I'm a beginner, so can you explain to me what a market maker does?
Yep. So what a market maker does is they are legally responsible to provide two-sided market in every option they're assigned to. Okay. So what that means is that, and I'm going to speak in today's world. Okay. In the old days, it was different. In today's world, there are, I might be a little off on this. There are like 12 there are more exchanges than there are market makers. Okay. Which is kind of crazy, right? So have you heard of Citadel? Have you heard of Susquehanna? Some of these names, Wolverine, these are all the big market makers in the industry. All people we were competitors with back in the day when I was doing this. So those entities are market makers now. Their responsibility, they are assigned to a stock, okay? They say, I want to be a market maker in Google, for instance, okay? And they have hundreds and hundreds of stocks they're assigned to. They are legally responsible to provide a two-sided market in every single option in Google.
Oh.
All the time that the market's open. Okay, now, there are rules as to how wide the markets can be, right? Based on premium levels, and you can be, $5 wide, $10. So they can do anything. And your size has to be, I think for a market maker, I think it's got to be 10 up, if I'm not mistaken. They could have changed that in recent times. But you have to append a size to each bid and offer. So if I'm a market maker and I'm one bid at 1 1/4, I've got to be 10 by 10. I can be 11 by 11 or 11 by 50, but I got to be at least 10 by 10 in all the options I'm assigned to. That could be, 20,000 different options. So if I'm making markets in 20,000 options as a firm, which is probably more like 100,000, you're getting hit all day long, right? All day long, you're getting hit. What happens to your deltas when you get hit? Well, who knows? You're getting hit in calls, hitting puts, you're buying some, you're selling some, boom, 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 boom. You're hedging all your sloppy deltas the whole day, right? To kind of keep that delta neutrality intact. Does that make sense a little bit?
Thank you.
When you say, did you say a 10 up, 10 down? Is that what you were saying? Just a second ago, when you were saying 10 up, 10 down, or
10 up. Yeah, so 10 up means 10 by 10. I'm willing to buy 10, sell 10. If I said I'm 10 by 20, I'm willing to buy 10 and sell 20. 10 by 30, willing to buy 10, sell 30. So you always had to have a size appended to your bid and offer. Okay. And
I see what you're saying. Okay. So even if all of your trades were absorbed, you'd still have to have the 10 and 20 like they're ready to go. Got it. You have
to come up with a new price. So if I'm $1 bid, someone says, Lex, I'll sell you 10. That's what I'm showing. Okay. Right. I buy 10. Well, if I'm still $1 bid, I have to have a size with it. But what do? I change my market. I'm 95-cent bid now at, 115. Right. So I have a new bid up and now I'm 10 again. If you hit me at 95, I bought 10 more. Now I'm 90-cent bid, and at some point, listen, I was in the Chrysler pit when Chrysler got taken over, and I was one of the few guys left who was standing there. And they came up with me and they said, Lex, I've got 500 to buy. What's your market? I'm like, 500? Holy cow. I don't know if I want to do 500. He goes, we don't care. We need a market. I said, okay. I said, 4.6. They paid 6 for 500. I'm like, sold. What the heck? Like I said, I'll do anything, and you're going to pay for it, though. And they're probably, I said 4.6. You know what they're probably worth? They're probably worth like 350. I knew he wanted to buy them. So I'm willing to pay more than they're worth, knowing that he's got to buy these things. And I'm trying to get as much as I can. I got $2.50 edge on a 500 lot, right? It's a lot of money. It's $100,000 on one trade.
That's the epitome of supply and demand right there.
Sorry, say again?
I said that's the epitome of supply and demand right there.
Right.
Oh yeah, right. And guess what? It's also that's exactly right. Supply and demand right there. And guess what else it's the epitome of? If you need to buy something, I am the one responsible for the other side of it, and you're going to only get it through me. And guess what? When you need it that bad, you're going to pay dearly for it, right? You are going to pay dearly for it. So I'm not in the business of giving you a great fill when I have risk to manage. But the markets nowadays, this is the beauty of the markets nowadays. You are in an unprecedented environment. It's been like that for years, since COVID probably. You have the most tremendous access to the most liquid markets that have ever existed in options, right? If you want to play the game in the top 250, right? Now you can also make a mockery of it by going somewhere nutty, but for the most part, there's 250 stocks, a lot of stocks, right? Where you can find a place to go. It's cheap to play the game. You don't need a staff. You don't need a building. You don't need anything. You need a computer and some brains. That's all you need, because other than that, it's easy to get in the game, right? And when the SEC FINRA gets rid of the pattern day trading rule, which is the dumbest rule on the planet, it's going to even be better for people who don't have $25,000 to play with.
Mm-hmm. Right? All right, who's next? Mark raised his hand. Mark, go ahead.
So we've had a lot of talk surrounding open interest and what we're looking for and the focus on that. And earlier you made a comment about you look at open interest and volume. If volume resets every day and you're someone who likes to trade in the morning, how can you cue any kind of info from that? Or is it just better to wait towards the end of the day where you have that extra liquidity, or like, do they interrelate at all?
Yeah. So the way I look at volume, what I do is I look back in time at volume. So I don't look at like the beginning of the day or the end of the day. I want to see a continuum. So like, for instance, let's take Tesla. If I go back and look at average daily volume in Tesla, I can see a number. It actually shows it in our system somewhere. And you can see what that number is. I just know like triple, 6-digit volume in an equity is pretty darn good. 100,000 or more is pretty good, right? And I know just from experience that most of that stuff is front weighted, meaning the nearer expiration is going to have more volume than as you go out in time. So if I could see that average daily volume as a big number, I feel really good about it. So even if the volume isn't there in the mornings, which it's not going to be, you're going to see a few smatterings here and there. And I'm not saying don't trade in the morning or trade at night only. Doesn't matter. As long as the stock is historically a high volume stock, you're in good hands. And that's how open interest can kind of play into it a little bit. If you see good open interest, it's going to have volume by the end of the day. Might not have it yet. You're safe. Look at those market widths, look at the OI, and then you're going to see volume eventually there. It's not going to be a problem. Yep.
All right. William, go ahead.
So to go back to the first part, you were talking about creating a market and the bid ask. Mm-hmm. So the market makers have to make the market for the option chains and for all the strikes. My question would be, the market makers are going to make money on that. Do they need to cover themselves or hedge by going out and buying stocks? So if I do want to open up, let's say 10 option contracts, is a market maker going to have to go out and buy up enough stock to cover the deltas? Or do they not need to do that because they're making their money on the actual bid ask itself?
Good question. Okay, so here's a couple answers. Okay, the answer to the question's changed over time. First of all, okay, and the reason I say that is when I first did this as an individual market maker. Remember, back when I started, every human entity that stood on that floor was considered a market maker. There's 10,000 of them. There's 7 left, 12. They're firms now. Okay. So the reason the answer is different is back in those days, I was responsible for, say, 20 stocks in my pit. That was it. I had 20. I could deal with 20. It's easy as a human, right? Now, market maker firms are responsible for thousands. So it's a little bit different. But to answer your question, in the old days, as an individual, we would hedge almost immediately, because remember how the option pricing, how the option model, the theoretical model is done. One of the inputs to the model is stock price. So if stock price is an input, whatever value that stock price is at the time will compute and spit out the theoretical value of that option I just traded at the time I traded it. So if I use the hedge of stock at that time, I'm technically locking in that theoretical edge at that time. So I do need to go to the stock market or something to hedge that option, right? So I don't give away my edge by a negative movement, in the call or put or whatever I've done. Does that make sense so far? Okay. The other thing, we taught this we had a university in our firm. So this is one of the things we like to teach is think about concentric circles. Everyone knows what that is. There's a dot in the middle and circles go around it, right? And it keep going. The farther out the concentric circles goes, the least sort of correlation there could be. Well, what's the best hedge for an option I just bought for 25 cents edge? Anyone have an answer? Anyone know what the best hedge is?
The closest one?
Good. Close. Who's
25 shares?
No. And who else? I didn't see you move their mouth. Okay. The best hedge is selling it. Let's say I bought it for $1. It's worth $1.25. Okay. And then the offer is $1.50. A great hedge would be what? Selling that same option out for $1.50. That'd be great. Why? It's in my bank. It's no longer on my sheets and at risk. And I've captured edge on both sides. I've made 25 cents on the bid and I've made 25 cents on my offer, and I'm out of the position. It doesn't exist anymore. It is money in my bank. That is the number one concentric circle right in the middle. Now, from that concentric circle, Chris, you could say stock. It's good. Very, very liquid hedge. Very beautiful hedge in the next concentric circle. What's the next one? Well, how about an option right around it? Another call or put right around the one I just sold. Same month, same term structure, same everything, kind of like the one I'm in. Then what? Same month, getting farther delta, bigger delta kind of thing. And then I use stock against the bigger delta. So you see what I mean? And then the next one you go, oh, let's go a month out. Now I've got a time spread on maybe or a diagonal. And then another month. And before you know it, you're trading a 0 DTE against a 2-year option. That's a horrible hedge, right? I mean, it's the concentric circle is miles apart. So what we try to do is we try to keep that concentric circle really, really tight and have like things against like things. Stock had no value to us. We did not know what the value of stock was. It was only a hedge with 100 deltas every time I traded it, right? And we used it as such. So, and one of the stories too, real quick, is that in the day, someone said to me, I got interviewed by CNBC, and they said, hey, Lex, double click. You guys remember that? I don't know if you guys remember that. It was one of the new stocks, hot stock, .com stock back in the day. Double click. You're excited. Is it a great prospect? What's the fundamentals of the guy? I looked at it and I go, I have no idea what this stock even does. Guess what? I don't even care. As long as it's liquid and we get a lot of options trading, I could care less what it does. It doesn't matter to me. You know, the guy thought, what a smart ass. So I go, well, it's true. We don't care. I mean, there's so many stocks I had no idea what they did. It didn't even matter. As long as they trade two-sided paper, God bless. Right?
Dude, that's how we feel around here. It doesn't matter what the stock is as long as it's trending in the direction. Yeah. Go ahead, Kasia.
Hey Lex, this is amazing. We should do this for like hours and hours.
Anytime.
My question is on float, where there's like more trades are being traded than there's actual trades that are like off that ticker.
Are you talking about the underlying? Is that what you're talking about? Yeah. So that happens. That can happen. It happens in the borrow world. So, you know, in the market maker world, we could sell things that we didn't own. So sell things short. And then our clearing firm would have to go locate that and borrow it for us. And sometimes we would be, hard to borrow, and we would get bought in when there wasn't enough stock out there. There's places you couldn't sell it, right? And if we did, we would sell it so poorly that it would be, you know, a horrible trade. It can happen. I don't know the details if that's happening a lot anymore. In those hard to borrows, I don't see a lot of them anymore, but it did happen in the past. And it would be a problem for us in the market making community because we need both sides of the market on stock to hedge ourselves. So we would have to really go to that market. And if it was oversubscribed and there's no more lenders of stock out there, what do? Right? We have to sell something. So we start banging on options a little bit, which gets to be negative edge for us. We don't want to do that. But it definitely can be a problem, right?
All right, who's next? Anybody? All right, we'll go to Stocky Locky. Go ahead.
Yeah, just a quick one, Lex.
Yep.
Nice to meet you, by the way. So I remember one of your events that you had Chris on the show at one point, and then you did a duo together on another session. And I think both times you mentioned about 0 DTE. I think you also said that you've come away from that and gone towards a 7 DTE. Yep. Obviously, we did around 21 on average.
Yep.
How was that profitable, the 0 DTE element? Because for us, it's a big no-no given the loss that we'd receive.
Yeah.
Dude, I call that like
yep.
I like to say that's like gamma radiation, right? That's when Spider-Man and the Hulk are battling each other inside the lab, right? There's so much gamma risk going on here.
Yeah, that's a great question. I would tell you this. What I said, I think, to Chris on the show is I came to a revelation, a realization for myself that 0 DTE for me is a tragedy. It is stay away from at all costs for me. Okay, now there are people who are good at it. I am not. I will be the first to admit I am not. As Chris said, there's too much gamma radiation in that, and you know it almost feels like a little bit of a binary event because it's either yes or no. It's almost like the event contract space. I'm either going to get it or I'm not, and I hate playing games like that. I feel like I have such a negative edge scenario there, and that's why I kind of moved into I even do a 1DT, and I'll tell you why in a second. I'll do a 1DT, but I love and you guys, I think you said, Chris, you're 21 days. Is that what you guys said?
Mm.
Okay.
Yeah.
Great honey zone. I like maybe a little bit shorter, like 11, but okay, I can deal in 21 too. Because 11 for me, just beyond, a week or two in business days, right? And things, remember, I'm a premium seller. Things start decaying fast.
Mm.
Every day that peels off that 11, all of a sudden, starts getting more and more kind of fuzzy for me, which is good. Whereas if you're buying premium, you want to be out in that 20-day because the theta doesn't hit you as bad, and you can kind of play the game. I find that it's almost like marinating meat, your chicken. I need to have a little marination time out there, and I don't want to be like, okay, I got to put it on the stove on a 0DT right now, otherwise it's going to rot. I can't do that. I need it to kind of move and wiggle and waggle. And even if I'm wrong on my trade idea or my trade idea generator, even with time, 11, 21, even a little bit more, I can still be right ultimately. It's not going to take me out of the game based on my exit strategy, right? So having that little bit of time gives you a bit of wiggle room to let it kind of, process, right? Mm-hmm. But I always stay by my rules. If it hits my exit spot, irrespective of where I am on the timeline, I'm taking it off or I'm rolling it, one of the two.
Cool.
Lex, do you still have more time for questions, or do you need to run?
No, I'm good. I got 15 more minutes. Is that okay?
Perfect. Awesome. Question from David in the chat, which goes to what you were just saying right there. Does Lex have a trading plan? I assume he does. Would you mind sharing some of that?
Yeah. So it's not fancy like your trading plan. I use a couple different things. And I will tell you, I don't use charts. I only use charts to what Chris has taught me so far. So that's the only way I use a chart. And I still probably don't do it right, I'm guessing. But maybe you can give me a little hand on that. Everyone knows Tom Sosnoff, right? He's the Thinkorswim guy. He and I were on the trading floor together back in the 80s and 90s. And I knew him from back then. But he said something, I just saw one of his podcasts recently from the past. And he said something that resonates with me great about charts. He goes, Batista asked him, hey, Tom, you read charts? He goes, no, I don't know how to read a chart. He goes, the only way I read a chart is I look to see if it's at the higher end of the range or the lower end of the range. You know what market makers are? They're contrarians, right? And why does he look at higher and lower ends of the range? Because he's looking to sell the higher end and buy the lower end. Because we're contrarians. It's in our DNA as a market maker. We always take the other side of things. So for me, I like to look at the chart to see, is it really high? And then what I'll do is I'll lean my spread into the highness, meaning I'll lean it short because it's so high. Now I'm usually wrong, but my trading plan is to get into a trade high volatility so I can sell something. And right now SPX is pretty high volatility for me right now. I can spread my trades out really far from at the money. And today is a good example. And I'm getting to my trade plan in a second. I had a loser today that turned into a winner because I was able to sell something that was really, really expensive, right? And as a result of that, I get to push myself out far enough where the move in that underlying SPX didn't hurt me. It had a little pain, right? It never got to my exit point where I had to make a decision, okay? Had it done that, I would have made a decision, but it never did. I played the game, ended up taking it off for the full profit that I wanted, right? In the day, rinse and repeat, moving on. It was not 0DTE. I did this the other day and had a 2 or a 1 day kind of thing. Okay. Because I am willing to take gap risk when volatility is high. And gap risk is I sell something today, which I did it before I got on the show with you guys. It expires tomorrow. Now, if we have Trump comes out and tweets something and the market's up or down, 100 spoo handles, it's gonna, I'm gonna have to make a decision. I know what I can lose. I know what it is. It's something I can handle based on my equity and all that kind of good stuff. I always manage that. I am a 5% on the high end of equity on any one trade or any one scenario, let's call it, right? That's what I like to do. I get out for a 50 to 70% of max profit number. And on the loss side, it's about a 50% loss of max loss. Mm-hmm. So of what I have in it, I should say. Does that make sense?
That makes total sense to me. Yeah.
So and look, when it's dancing around 48, 49, 50, 51, I kind of sit there for a little bit. And if I get 52 or 53, I'm not going to cry, but I don't want 70, 60% loss. When it gets 50, I'm thinking I'm rolling depending on the situation, or I'm getting out, depending on the situation. And unfortunately, in zero DTs, it forces you to get out, right? Because everything else is so cheap now. Where are you going to move it, right? You got to move it to the next expiration cycle, technically. So I just like to take things off on the 1DTs, and everything else I have tends to be in equities, tends to be in that 11 to 21 day range. And because I have, a reason for doing things. Right. And I love earnings plays. That's another whole episode.
Oh, really? I avoid earnings like the plague.
Oh, I love earnings. I hit a double bagger the other day in Palantir. So we'll talk about it another time. It's too long.
Sure.
Yeah.
What about, do you have any book recommendations on trading? Does Lex know how to read?
Yes, I would know how to read. I don't have a book on trading, but I do have a book on the markets. It's the Options Playbook. It's written by Brian Overby. He's one of my colleagues, and he's one of the hosts on one of our shows during the week. It's one of the newer, modern, good books, especially for beginners. I think one of the ladies here said she was a beginner. It's a great book to get your sink your teeth into and really start learning about it. So he's really good. Yours truly is writing a book. Okay, I'm writing.
Oh yeah,
right. I'm giving you a plug. Now you can't get the book yet, but I'm writing it, and it's going to be around these topics. And it's going to be around what I discovered about retail trading that I didn't know being on the other side, and that I've learned over the course of time being on the retail side so much. It's essentially the theme is keep it simple, stupid. And I'm going to debunk understanding all the Greeks to their nth degree. It's almost like, and I always like to tell Chris this too, and people who will listen, everyone drives a car. Right? I'm assuming everyone comes up to a stoplight and sees that stoplight turn yellow, and you have a decision to make when it turns yellow. Are you going to hit the gas and go through, or are you going to hit the brake and stop? Right? And then it turns red and you should stop. And then when it turns green, hopefully you look both ways before you jam the accelerator so no one's running through a red light, and you proceed. Right? Very simple to understand. Agreed? Well, if I said to you, I want you to derive how all that happens in that little box up there and tell me the algorithm that makes that happen, all of a sudden you might be like, I don't know how that happens. Is there weight in the road that causes it? When there's a lot of them there, and now it changes it. And what's the timer doing, and how those things click inside that machine? You'd say, why do I need to know that? And I'm telling you that you don't. You need to know what to do when the colors are shown to you, just like in options. Do you need to know how to derive the option pricing model? No. Is it a great cocktail party item? Yes. Really cool. Should you be familiar with the dials in the cockpit when you're flying an airplane? Probably. You probably should know what they do. Just like in options trading, get an idea of what all it is. Someone said to me the other day, Lex, you sold that spread. What are your deltas? I looked at them, I go, what are my deltas? I don't know what my damn deltas are. I sold it for $3. I want to buy it back for $2, and that's it. That's my delta, right? And I want to do that 1 million times a year. I go,
exactly.
Idea. If you ask me what my deltas are, I have no idea. I know what they are. If you push me to it and said this spread, I go, I can tell you exactly what it is, but I don't care. So point of the matter is, I'm making a retail book so that you have a handful of trades that you need to know. Call spread, put spread, maybe a few butterflies, being long an 80 delta call or an 80 delta put, blah, 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 blah. Forget about everything else. Don't cloud your mind up. You don't need it as a retail person, right?
Dude, that's exactly what I say. Exactly what I say. In fact, I have a very similar story to what you're just explaining. So I used to work with a guy who had a CFA, and as you know, CFAs feel like they walk on water. And we were having a conversation one day, and I was starting to make money in options, and he goes, "Oh, well, if you're so smart, what's the Black-Scholes options pricing model?" And I literally looked him dead in the eyes, and I said, "I don't have to know it. All I need to know is how to make money using it."
Yep. 100%.
There you go. Exactly.
Yep.
Kashta, did you have a question?
I do. It actually came from one of the Alpha University students. And so we talk about the outlier effect, where outlier is not meant to be a copy trade, the trade copy system, but inevitably a lot of us would get into the same stock at a very similar time frame. And we'd love to hear your thoughts about, if 2,000 of us buy 20 contracts each, like what is that actually going to do to the underlying stock or the option for that matter?
Yeah, I think how many is it? Would you say 2,000 times 20?
I mean, I could see
I'm
10,000 contracts coming in, maybe more.
Yeah.
Yeah, I think it depends on the underline, right? You will get negative effects in lighter underlines, leaner underlines. You will have very little effect in an SPX or the highly liquid places. Spider, it won't even be a breath in spiders. But if you're trading, look at that's part of the reason GME did what it did, right? Because the market making community got caught in a gamma squeeze, an Ivana squeeze in that product because it was so thin to begin with. And they held all the cards on the other side, right? So my answer is that it can certainly have a profound effect in less liquid stocks and options, but probably not much of an effect in an SPX or bigger liquidity. A Tesla, probably nothing, probably very little, right? Now, having said that, though, a market maker, even today, in today's world, who has billions and billions and billions of dollars, okay, behind them, they would much rather see little 10 lots floating back and forth, right and left, instead of one big 10,000 lot comes in at once, except if they know that's the only one that's coming. Okay, there's a big difference because if I'm making you a market and I ask you, how many you got? And you say, I need to move 10,000. I go, is that all you got? And you say yes, and you're telling me the truth. I will give you a very good price and you will get a happy fill. But if you say, I'm not sure, there might be 10,000 more after it and another 10,000, now 30,000 in this example, I'm going to have a different answer for you. Okay, I'm going to protect myself and I'm going to give you a worse fill on that first 10,000 because I don't know what's coming next. And market makers always want to be in on that. The biggest part of their trade is the highest price they can get on the sell side and the lowest price on the buy side. Does that make sense?
Is that why when a stock gets a lot of excitement, the bid and ask spread will widen out really fast or even collapse really fast?
Yeah, it will definitely do that because what happens, even a little bit if your community is hitting a specific stock, you'll see a little bit of pulsing, because all the market makers doing is saying, I need a breath, just need a little breath here. Let me get a breath. Let me get my hedges, kind of thing. And all they're doing is doing their hedges to manage that inventory. Right. So.
All right. Any other questions from students in class? Oh, William, go ahead.
So to follow up on that, then would you say that buying options at the beginning of the day might not be the best idea because there is so much volatility upon market open, especially after like an earnings report, or if you see UNH drops, 20% overnight or something?
Yeah. So great question. Another part of the Lex plan, I tend not to trade options between again, I'm on Central Time, right? 8:30 to about 9 o'clock, give or take 5 or 10 minutes. I try not to touch it. Now, the only exception there is if I'm short something overnight and it hits my level, I'll put my limit price into the marketplace. And if I get filled in that 30-minute window, I'm perfectly happy with it to rinse and repeat and start again, toward the end of the day. That's the only time. I will not initiate new trades in that half-hour window. And I try to stay away from 2:30 to initiating new stuff for the most part. One of the reasons is in the morning, market makers get books. Okay. So what happens is they got order flow that stacks up before the opening, and they may have big pricing mechanisms and they're seeing, I got 10,000 to fill here and I got 3,000 here and I got this and that. So they're trying to price their opening markets. And a lot of times they'll do that and they'll widen things out and it'll pulse wide in that first half hour because they're trying to set, liquidity and set, again, just like a bookie. A lot of buyers. What happens when someone just says, I'll bet on this horse and they bet $2 million? Well, guess what? The odds are going to change. Same kind of concept, relative to market making. If people get one-sided too much, they're going to start changing their markets, widen them out and get themselves some safety. Does that make a little sense too? Okay.
So then you said the same thing about the last 30 minutes of the day as well then.
Yeah, again, the 30 minutes happens too. What happens there is, again, you get market on close orders, right? A lot. So you start getting inundated before the actual regular session closes. And sometimes it gets out of balance a lot. Market makers are kind of, they're kind of consolidating their books at the end of the day, making sure everything's kind of more or less flat. Doesn't happen as much anymore because, again, these are billion-dollar firms. They're not individuals anymore or small companies. So, they're probably dispersed this a good bit. So it's not as prevalent as it used to be. But that first half hour, I'm more adamant on than I am in the last 30 minutes of the day.
Oh, Carol, go ahead.
Hey, Lex. Question: as a market maker, we're holding options and we put limit orders in to get out, and say we try to have a target, obviously for a win, but if we're doing a stop loss as an example. I've noticed that there is more of a frequency if I'm trying to get out and quote, get in the way for the market maker, those typically get filled. Would you say that's an approach a market maker takes just to close that out and get it out of the way for the day? Does that make sense?
Yeah, I think that if a market maker firm can see stop orders on the book, I don't think they're going to pay a ton of attention to smaller lots, ones, twos, fives, tens, 20s, hundreds. I think if it becomes thousands and beyond, they'll pay attention. So if they see, and I can be honest, in the old days, being on the floor, we would be able to see that level 2 information on the screen for us. So if someone put in a stop order underneath the market or something like that, we certainly could see that. And if it were 10,000 lot, I guarantee you we were putting in stock bids that made our selling that call in this example, let's say, that when we got filled on the stock, we'd start hitting that bid that's sitting up there because, again, we're locking in that edge, right? We're buying stock, selling calls. So that can happen. Now, to what degree that happens nowadays with all the electronics, I think it's probably not a big deal anymore. I think these machines are so inhuman that they can do, you've seen, ChatGPT and all that. It's amazing what can be done now. And these machines are just surveying all these positions and marks just like in microseconds. It's crazy. So I don't think it hurts you at this point, especially with smaller lots. I don't think they pay attention. If it's 10,000 lot, yeah, that might be a little bit of a, bell goes off kind of thing. Yep.
Thank you.
Hey, Lex, I know you got to be short on time. Can we ask you one more question?
Sure, please.
All right. Sorry, my Alexa heard me. She didn't like that. Open interest versus volume. Which is a better indicator of liquidity on an options contract?
At the end of the day, I think probably open interest is only because when you see it open, it has to close. So, if you see a lot of it, there's going to be trading in it. You can have one-off volume days, right, in a stock because it's got news and it looks like there's a lot of activity. I like to look at open interest, okay? And the reason is what I just said. Like if I go to a new stock, first thing I do is I look at the open interest column on Tradier Pro. If I see double digits, I'm like, ugh. If I see zeros, gaps, I'm like, ugh. And then I'm like, okay, let me see a market width now. Ugh, that's too wide. Guess what I do? Swipe, move on to the next one. I don't do it. But if I see open interest that is, again, I love seeing at least 4 digits and it's everywhere around that at the money band pretty well. Okay. And the markets are fairly tight. I'm a player now. Right. So I like open interest better. I don't think there's an absolute correct answer. I think open interest tells a better story.
Yeah, that makes sense. And I'm glad we had this conversation, Lex. So we've gotten a ton of really good feedback. And a lot of people saying they'd love to have you back on again in the future for another guest lecture. Yeah, I have some things that I want to go investigate for me and my own personal plan, like the spread being 10% bid and ask. I like that idea. One thing definitely I want to start implementing right away is just no market orders, even on stock. Just make it a limit order, so you remove the risk of an infinity trade going against you. That makes total sense.
Yeah, and then put a lien on it. If you need to. If you need to give peace of mind, you'll get filled. Listen, those people got filled at $100. If they had $1 lien on it, they would have gotten filled at the $1 lien. They would have gotten filled. Save themselves many dollars. Okay. So Chris, great. The other thing I say is, Chris and I are going to probably do more webinars like we did before. Number one, and if it's okay, because Chris is going to probably be a guest speaker, we're planning a live summit in early May in Palm Beach, Florida, West Palm Beach, Florida. So by, just if there's any way you can gauge interest from people. I'm not sure about cost yet. We're going to try to make it free to you to come. That doesn't mean we're going to pay for your flights and pay for your lodging, but we're going to not charge you anything to go to the summit. But guys like Chris will speak. I will definitely be emceeing and speaking. We'll have panels. We'll have lots of education. We'll have fun. We'll have cocktail parties, yada, yada. It'll be a day and a half coming in on a Thursday, all day Friday thing. You can leave Friday or stay the weekend with whomever if you'd like. So just, if you can get a little loose survey of what kind of interest there is, Chris, that'd be awesome.
Yeah, for sure. I actually am looking at this like this is an opportunity for like an outlier meetup. So we might potentially bring maybe 1,000 people with us. That would be amazing if we could bring a ton of people with us. So y'all heard it straight from Lex. Is it happening, Lex? Are we booked? I know last time we talked, you were talking the hotels.
Yeah. Well, so the early line it's PGA National. So the OIC event is the few days before. I'll be at that. And the OIC is the Option Industry Council. Big industry event. Okay. Not so much retail, a little bit more institutional, but we like to go to that. And I know a lot of people there. Right after that event, the plan is to have our Tradier SIBO Summit, SIBO sponsoring with us. And obviously it's gonna be open to everyone. And we're just getting the early planning stages. I'm waiting for PGA to get back to me. They're supposed to give me something today on cost and price. We're trying to get that all honed in. Once we have those numbers, out go the invitations. And yours truly, Chris, I hope will come and present and be part of the stage with us. It would be awesome.
I'll be glad to be there, Lex. I can't wait to do it. And Lex, really, I want everybody to say thank you to Lex in the comments. And, let's give Lex a little golf clap. I mean, this is the best that we can do over here.
Yeah, thank you, guys. I really enjoy this. I love doing this kind of stuff. Would love to do it live with you guys. And I'll do this again anytime you want. There's many more stories for Uncle Lex. I promise. I got many more.
I can't wait. Well, what's fun about this, Lex, is this is the BravoU class, and they actually graduate next Thursday. Next Thursday, they will be graduates, and we're going to let them go free from the nest. Can you believe that?
Love it. Congratulations, everybody. This is fantastic.
I agree.
Awesome.
That's just because he's tired of dealing with us.
That is true. That is true. Actually, one of the things that I'm starting, Lex, is a champion trader interview series. So I've got, I'm competing in the U.S. Investing Championship this year. Yep. Several of our outliers are as well, but also I've already booked Mark Minervini. He's going to be here. Norm Zada, who runs the competition, he's going to be here. We've got 9 other competitors already lined up. So I think we're looking at probably 20, 25 people deep of champion traders who are going to come on live just like this and be able to ask questions and learn as much as we possibly can from them. So here at Outlier, we're trying to make people successful. That is our goal at the end of the day.
That's good. It's a good goal. Excellent. Great meeting you guys. Great talking to you guys. I loved it. Thanks for having me.
Cool, Lex. Thanks for coming, and thank you everybody for being here in class today. I will see you next week. We'll go ahead and end the stream right here. Y'all take care.